Momentum indicators. They measure the speed and magnitude of recent price changes, helping to assess the strength and potential continuation of a trend. Example, the MACD indicator. Green histogram bars indicate bullish momentum, red histogram bars indicate bearish momentum. Now, dark green histogram bars indicate that the bullish momentum of the market is increasing, but light green histogram bars indicate a decline of the bullish momentum. On the other hand, bright red histogram bars indicate an increasing bearish momentum. At the same time, light red histogram bars indicate a decline of the pre-existing bearish momentum. Take long positions whenever the histogram is dark green and short positions when the histogram is bright red. Volume indicators. These analyze the volume of trades to confirm the strength and sustainability of price movements. Example, the Hawkeye Volume Indicator. This uses histogram bars and a moving average to track the volume of the market. Green bars indicate bullish volume, red bars indicate bearish volume, but gray bars indicate neutrality or a lack of volume in the market. Now, when using this indicator to trade, you want to take long positions whenever the green bars are above this moving average, and short positions whenever the red bars are above the moving average. But if the bars are gray, you want to stay out of the market. Divergence indicators. These are used to identify when a price trend diverges from an oscillator, signaling potential reversals or changes in the direction of the trend. Example, divergence histogram for many indicators by LoneSomeTheBlue. This tool identifies divergences using 11 indicators and plots these divergences as histogram bars. Green bars indicate bullish divergences, red bars indicate bearish divergences. These numbers up at the top represent the number of indicators that signaled a particular divergence. In conjunction with other confluences, you can take long positions whenever there is a green bar and short positions whenever there is a red bar. Obviously, the bigger the number at the top, the better. Overextension indicators. These are used to identify when prices have moved too far, too fast, indicating overbought and oversold conditions. Example, the money flow index. Values above 80 indicate overbought conditions, and values below 20 indicate oversold conditions, suggesting potential reversal points. To take long positions, you want this indicator to go under the 20 level, and that area should also be a bullish divergence. And for short positions, this oscillator should go above the 80 level, and at the same time, it should indicate a bearish divergence. Buy-sell indicators. These are tools that utilize various price action methodologies to provide clear, actionable signals for buying and selling assets. Example, the PineTrades Market Beacon. Whenever there is a long signal like this, you take a long trade. Conversely, whenever there is a short signal like this, you take a short trade. Remember, this is a private indicator, so to get access to it, you want to use this link down in the video description to get a 30% discount as well as a 14-day money-back guarantee. Trend indicators. These are used to identify the trend direction and strength of a particular trend, providing insights into potential continuation or reversal of the trend. Example, the Trend Strength Signals Indicator by AlgoAlpha. This is a trend cloud that can be used to identify the direction of the trend. A bullish trend is confirmed when this cloud is angled upward like this and the price is trading above it. Conversely, a bearish trend is going to be confirmed when this cloud is angled downwards like this and the price is trading under it. This indicator also has a trend strength gauge that can be used to indicate the strength of the trend. This pointer is going to be used to indicate the strength. The higher it goes, the stronger the trend. However, the lower it gets, the weaker the trend. When using this indicator to trade, you obviously want this arrow to be pointed as high as possible. Combine that with other indicators or maybe some buy-sell indicators and some price action concepts, and you could have a profitable strategy. Support and resistance indicators. These are used to identify levels where the price tends to find support or resistance, indicating potential reversals or breakout points. Example, the support and resistance indicator by ChartPrime. This indicator identifies key support and resistance levels using pivot points and volume analysis. It then visually represents these levels using these boxes. Green boxes are the support levels, while red boxes are the resistance levels. To trade with this indicator, you want to identify a resistance level, wait for the break of the level. After the break, wait for a retest of the level, and then you take your long position. And of course, for short positions, you're going to do the opposite. Smart Money Concepts Indicators. These tools focus on the behavior of institutional investors and large traders to gauge the market sentiment and potential future price movements. Example, the Smart Money Concepts Indicator by Lux Algo. This is an all-in-one indicator that displays real-time market structure, order blocks, premium and discount zones, equal highs, equal lows, etc. For market structure labels, we have bullish change of character labels and bearish change of character labels. There is also bullish break of structure labels and bearish break of structure labels. To trade with this indicator, you want to identify a bullish trend, and then at the end of the trend, you want a change of character to happen, followed by a break of structure. And then you take a short position. And of course, it's going to be the opposite for a long position. You can also use retests to these order block levels for more trades. Next, we have HKER trade indicators. These are indicators that you can use to trade and make millions of dollars every single day. Nah, I'm just kidding. HKER trade is actually the trading platform that I normally use. I've actually been using them for quite some time. As you can see here, this is my live account on HKER X, which is a new trading platform that they recently launched. The reason why I love HKER trade so much is because of their low commissions and spreads. They also have a maximum leverage of 1 to 500. You know, for those of us who love high leverage. Now, if all of these aren't enough, they're also going to give you a 100% deposit bonus for all your first deposits of between $100 all the way to $25,000. So if you deposit, say, $500, they're going to give you a bonus of $500, giving you a total of $1,000 to trade with. To access the bonus, as well as all the other perks, sign up to HKER Trade using the link in the video description. Now, back to the video. Next, we have volatility indicators. These measure the rate of price fluctuations over time, helping to assess the potential risk and reward of a security. Example, the average true range, or ATR for short. This indicator measures the market volatility by looking at the average range between high and low prices over a set period. If you have a trading strategy and you want to take a long position, then you just hover over your entry candle, look at the ATR value. Higher numbers indicate high volatility, which tells you that your stop loss should be wider than normal. And then lower numbers indicate low volatility, which means you can have tighter stop losses. Candlestick pattern indicators. These use specific formations of candlesticks to predict future price movements. Example, the All Candlestick Patterns Indicator by TradingBeer. This indicator has a lot of different candlestick patterns like the doji, the engulfing candles, the hammer candles, Morningstar, tweezers, etc. You can see the full list right here. Simply activate whatever candlestick pattern that you need this indicator to identify, and it's going to be labeled on your chart. Combine that with other price action confluences to create your strategy. Now remember, blue labels indicate bullish candlestick patterns and red labels indicate bearish candlestick patterns. Next, we have chart pattern indicators. These are different from candlestick pattern indicators because they focus on chart patterns. These are used to identify specific price formations that signal potential future price movements. Example, the Auto Chart Pattern Indicator by Trendoscope. This automatically identifies and classifies chart patterns using a sophisticated algorithm. It employs a multi-level recursive zigzag method to analyze different zigzag lengths and depths. This indicator categorizes patterns based on geometrical shapes, which gives us the wedges, triangles, and channels. It also categorizes them based on pattern direction, which gives us ascending, descending, and flat patterns. And lastly, it categorizes them based on dynamics, giving us converging, diverging, or parallel patterns. Users can customize the settings of this indicator to suit their needs. Channel indicators. These are used to create channels around price movements to identify the trends and potential reversal points. Example, the Keltner Channels indicator by TradingBeer. This indicator consists of an upper envelope above a middle line and a lower envelope below the middle line. This middle line is actually a moving average of price over a user-defined period. This indicator can be used for 1. To measure the strength of a trend. During an uptrend, breakthroughs of the upper envelope indicate the underlying strength of the trend. Conversely, During a downtrend, breakthroughs of the lower envelope indicate the strength of the trend. This indicator can also be used to indicate oversold and overbought levels. In consolidating markets, the upper and lower bands can indicate overbought and oversold conditions. Breakthroughs of the upper band may lead to the price coming back down, while breakthroughs of the lower band may lead to the price going back up. Retracement indicators. Example, the Fibonacci retracement. This tool identifies potential support and resistance levels using horizontal lines that correspond to Fibonacci levels. These levels are derived from a significant price movement and are used to predict future price reversals. To use the Fibonacci retracement tool, follow these steps. First, start by identifying a swing low and a swing high on the chart. Drag the tool from the swing low to the swing high and then wait for the price to make a pullback to one of these Fibonacci levels. One key level to watch is the 0.382 Fibonacci level. This is a common level where prices tend to reverse. If the price touches this level, it can be a good buy entry point. However, price could also reverse from any other Fibonacci level, so it's important to combine this tool with other confirmation signals for a better entry. That's been it for this video. I hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching. See you next time.